Now, economies across the continent have been exploring the different ways in which new tech can help authorities meet the goals of expanding financial inclusion while also making cross-border trade and investments a lot easier and faster. Now, in response to the explosive rise of the use of cryptocurrencies, some central banks are now exploring issuing what are known as CBDCs, central bank digital currencies. Nigeria was the first African country to issue its own CBDC, first out of the gate with the eNaira last October. By the end of January, 700,000 eNaira wallets had been active. Over 9 million transfers and payments had been made with the eNaira in a country, remember, that is home to about 200 million people. So what then should happen next? Well, the Central Bank of Nigeria plans to allow users without a bank account to open eNaira wallets using only their national ID number. Right now, you can only open an eNaira wallet if you link it to your Nigerian bank account. The CBN also plans to allow Nigerians in the diaspora to send remittances in eNaira. But for this to work, the International Monetary Fund is warning that it is important, quote, to strengthen confidence in the local currency and to support a unified market clearing exchange rate, end of quote. This was part of my conversation with the director of the Africa Department at the IMF a little earlier on the promise and the perils of CBDCs in Africa.
First and foremost, you said you're surprised, but, I think our countries have been really in the vanguard in terms of advancing, benefiting from fintech, right? The digital revolution in Africa is really one of the things that has not been enough written about and acknowledged. So I think, many of our countries have been in the vanguard, and it's only appropriate that central banks also ready themselves to consider initiatives like digital currencies. Now, we also highlight that, look, this is not a panacea. Huh? It's not a silver bullet that will address the inclusion challenges that we have in our countries, or improve payment systems. There's actually a lot of work, plumbing work that needs to be done to make sure that digital currencies can be effective. Second, as you begin thinking about adopting digital currencies, you also have to keep in mind the inclusion aspect. While there's been tremendous penetration by technology, by mobile phone into systems, into our countries, by no means is that universal, and there still remain a lot of people without access to mobile phones, much less smartphones. So again, that inclusion aspect cannot be ignored. So we basically are highlighting the pros and cons, but if our continent, if our people, if our countries are going to be leapfrogging technologies, consideration of things like central bank digital currencies has to be part and parcel of that.
But by implication, it also sort of implies an extension to some extent of central bank mandates into the business of payments, for lack of a better word. Can you talk us through the potential there? Because one of the things I know you raise in the report is that this might actually help to make remittances, for example, a lot easier, a lot faster to pull off in countries that essentially have correspondent relationships. But when central banks are expanding their mandate in that sense, are they able to execute that properly? Because it essentially puts them into competition with the same entities to some extent that they regulate.
This is exactly what we're drawing attention to. That indeed these things need very, very careful thinking about as central banks are launching or considering launching digital currencies. You don't want to disintermediate financial institutions that are doing this well already. So this is exactly what we're drawing attention to, and the need to strike a balanced approach